So the meaning we are discussed. This is a recap. Okay, so the meaning, so the finance, it is the most important one. Without the finance, we are not able to run anything. It may be in the house or it may be in the organization or anywhere. So the finance, it is a flow of money they will be analyzing. The flow of money means how much we are invested as well as how much we will be retained from the same process by the through the organization that we are discussed. And the next one, it is the definitions. It was given by John J. Hampton. So the term finance can be defined as the management. It is also the flow of money through an organization. So through an organization, whether the organization means the corporation, government agencies, school, universities, colleges, everything there be comes under the same. So what is the meaning of financial management? So the financial management means it is we have a finance, we have to be effectively, efficiently utilize a particular one. So if we have resources of finance means we have to be effectively utilized through the organization. So which means we are creating a balance among the financial planning as well as a requirement of funds, profit administration, and also the sources of funds. So the definition which was given by Broadly. So it is an area of business management. It is devoted to the judicious use of capital and careful selection of sources of capital in order to enable the spending unit to move in the direction of reaching their goal. What is the goal of the organization? Profit maximization. So we can raise our profit or otherwise we can reduce our cost of expenditures also. So this is the role of financial manager. So which it is consist of five. That is a financial forecasting and planning. We have to be forecast what will be happen in the future. That we have to be forecast as well as we have to be planned based upon that. And the next one, acquisition of funds. So the next one, investments of funds, where we have to be invest, where we have to be collect that and all, and helping in valuation division, that it is we have to be help to them for the valuation. For example, in the future, how much which it is retained from the organization, how much we can invest it nowadays, as well as how much we can that is a retained from the particular manufacturing or any other business activities. And finally, a financial manager have keep their proper liquidity with themselves. So proper liquidity means the cash, it is a liquidity. So the cash, it is a major source in every family members. They are using the cash when they are receiving a salary till the end of the month. They will be maintaining the cash liquidity with themselves. So whenever it is needed, immediately we have to be give that is easily to accessible. That it is called as a liquidity that will be maintained by the financial manager. These are the major role of financial manager. So this is the sources of raising finance. So we can raise our finance in two ways. That is, one is internal as well as another one is external. So in this case, internal means retain the profit, sales of existing assets as well as cut down stock levels. But in case on the external means we can getting amount from the other sources outside of the persons, that is outside of the organization. That is a long term loan, medium term, short term loan. These three kinds will be comes under the external. In this case, the internal means the retained profit. The retained profit means already we are saving, that is our organization, they are saving the reserves and surpluses in the previous year. That amount we can utilize nowadays. As well as if it is needed some property or assets, we can sell it. And we can raise up funds to run a business nowadays. And the third one, it is cut down stock levels. So we have to be reduce our stock levels. We can reduce. Now it is not necessary to give more stock, means we can cut down on that and we will be give some other important to the other process. Then in case in the external means, the first one, it is a long term. So these are the ways we can raise our long term finance. There are shares, debentures, okay, and public deposits. So the shares we can raise through it a debenture as well as preference shares like that and all we can issue to the public. And the debenture, which it is divided into category, that is a retained earnings, and another one is term loans from bank. We can collect it from the bank also. And the next one, it is a public deposits. So and through that public deposits, we can collect it. That is a loan from financial institution, ICICI, IDIB, like that. Many institutions, they are ready to issue their loans to the organization. So the next one, it is a medium term and short term loan. So the medium term means it is a leasing, lease. So we are going on to some houses for the lease like that, and all the organization also doing the same, as well as higher purchases. They will be purchasing. That is, they will be paying few amounts. That is a minimum amount nowadays, and every month they will be going to pay. So that also will be considered the higher purchase. And the next one, it is a medium term loan. And medium term loan means that is a few months only it will be. So we can repay to the within a few months. That will be considered the medium term loan. And the short term, it is a very short period, minimum 1 year. So the bank overdraft, okay, 1 month only. There will be 1 month or how much. That is a only for those who are availing more than 1 lakh transaction per day. They will be avail that bank overdraft transaction, as well as bank loan. They will be getting credit as some few members. Those who know, they will be giving an credited to us. That is a paying amount that and all, and debt factoring also will be there. So the next one, it is the raising of finance for a company. It consists of 12 methods. Okay, so the first one, it is a shares. So the shares means it is a when a company, when the new company they are issuing to the public. That is, they are issuing to the shares. They are raising a funds through the shares. So in this cases, it will be the first one. It is a preference share. So what it is that preference shares? The preference share means it is a person holding these shares is entitled to get fixed rate of dividend. They will be getting a fixed rate of dividend. So and also his get a rate of dividend before any amount to pay to ordinary shareholder. Before paying to the ordinary shareholders, okay. So the company paying to the preference shareholder. So this is a name suggests for the preference shareholder. So it is divided in two categories. One is cumulative preference share and another one is non-cumulative preference share. So what is that cumulative preference share? If the profit are not sufficient to pay the fixed dividend in a particular year. So every year they are paying to the preference shareholder for the dividend amount. Okay. So on that particular year, it is not sufficient to pay the fixed dividend in a particular year means then the deficit, that is a deficit, that is a paid up capital means they will be paying into the dividend amount will be paid into the next year. That is cumulative preference share. So another one, it is a non-cumulative share. So the dividend is not transferred to the next year. Okay, if the profit of any year are insufficient to pay the fixed dividend means we shall not be pay for the future. That is the next forthcoming year. So that is non-cumulative preference share. They will be mentioned when they are issuing the shares for the preference. They will be mentioning which kind of shares, preference share is that they will be issuing. Another one, it is another one, it is an ordinary share. Ordinary share means these shares get their dividend only after payment of the fixed dividend on the preference shareholder. When we are paid everything to the preference shareholder, after that only the remaining amount will be divided into the ordinary shareholder. So the advantages of the ordinary shareholders of the ordinary share is that there is no limit of dividend. But we are already fixed for the preference share. It may be the 5%, 8%, like that and all, it will be fixed. But in the ordinary shareholder, we are not fixing any amount to them. Because of the remaining profit shall be divided into the based upon their shares. Based upon their share ratio, we are paying to the dividend amount. And the next one, it is a deferred shares. So as the name suggests that these shares have their clients lost of all. That is the holders, that is these kind of holders of these shares get their dividend only after the payment of the dividend to all other classes of shares. So all the other cases means it may be in the preference shareholders, these kind. After that only the remaining amount will be shared to the deferred shareholder. Who are comes under the deferred shareholder? That is the promoters. So who are initially taken to start a particular business or a particular organization, that person will be comes under the deferred shareholders. These are persons who have helped in the formation of a company. So we are paying to them also. Right. So the next one, it is for the debenture. When a company desires to raise the required finance through loans instead of sale of shares, then debentures are issued in these ways. Okay, in these ways, the advantages of because of this, the debenture holders cannot claim a for ownership. So only shareholder having an ownership. The preference shareholder also they are not having an ownership of that company. Okay, but in this case, special cases for the debenture holders, instead of sale of shares, the debentures are issued. When the debentures are issued, So in this ways, the major advantages of the organization is the debenture holders cannot claim for the ownership and he is paid the interest only. Preference shareholder, equity shareholder, we are paying for dividend. But and the debenture holders, we are paying only for the interest. So these debentures may be issued either for initial needs of an enterprises or for the development and extension. Okay, and the development and the extension of the organization. When it is needed, we can raise the funds to debenture. So these debenture holders has no liabilities and the debenture provides finance for a specified period only. And the company can adjust its financial plan based upon it. Okay. So the next one, it is a public deposits. Some of the concerns raise their capital by accepting the deposits direct from the public for fixed term. Generally, the fixed term means 6 months or to 7 years. 6 months to 7 years they are using. So the fixed capital is generally raised. Okay, it is generally raised through long-term deposits. The fixed deposits comes under the long-term deposits, while working capital by a short period deposits. Working capital should comes under the short period. Okay, so in our India, this method was being employed by cotton mills only. They are using, especially those located at Ahmedabad, Mumbai, and Solapur. Okay, these are the places they are mostly using this one. So these deposits are taken for 6 months in the purchasing season only. When the cotton capital low and to the borrowed at cheap rates, they will be buying at a lower rate, not on a cheap rate. It is on the lower rate, and they will be processing the works, everything. After completing that, they will be selling to them. Okay. And the next one, it is for the managing agent. So this source has played a very important role in early days of industrial development in India for setting up and development of industries. It is very important one they are used. So in this case, the managing agents have provided fixed and working capital themselves. Okay, and also they will be arranged through the other sources like which includes their friends and relatives to purchase shares and debentures. They will be giving and that is selling to their relatives and other people, as well as they are arranging loans from the banks and public debts from banks. After some years, for the working capital requirement of industries, and their world will be facing a little problem on that. So this system was followed due to security reasons only. So what is the major reason? They want to be some security. So, but from this policy, small entrepreneurs was most suffer because of the small entrepreneurs. They are not able to. They have minimal amount. It is not enough to give a um, good and an organization, because of they need little more amount than only. Because of long term means it will be very secure. They will be feel that it will be raising a profit and a more and more, as well as now. But nowadays the State Bank of India and other nationalized banks, they are providing financial assistance also to the small scale industries. They are providing under the liberalized means it may be in the short term or long term either cases. So the loans are granted to these industries under liberalized scheme, and these loans are granted to these industries for fixed as well as working capital requirement. That is a long term as well as in the short term also. And the next sixth point, that is plugging back of earnings. So every developing industry requires capital for their extension and improvements. So ideal method of financing for extension and improvement of an industry is a reinvestment of a part of the profits. So which it is known as a plugging back of earnings. So these reserve of capital build up during a continuous spell of prosperous period, and it can be used as working capital. So this system, especially this system, provides sound financial management in an organization. And this one which helps in the depression period, in addition to that for expansion and improvement of the concern, that is an organization. Then the next one, it is a hire purchase. In hire purchase system, machineries etc will be there. When required, we can be obtained for use, and number of periodical money installmentally we are paying to them. Okay, so at the end of the period, when all the installments have been paid, then only the ownership will be transferred to the particular person, or otherwise it should not be transferred. The ownership should not be transferred to them. And another one, it is a leasing. So it is a fixed assets like land, machinery, etc. And it can be obtained on lease for a number of years on rental basis. It is on the rental basis. A particular period we are paying something and we are rebating the same amount or lesser than few amounts we will be living that. And the next one, it is for the profit flow back. So the profit is not distributed to the shareholders or owners. So the dividend amount we are paying, but the whole profit should not be transferred to them. And the owners, and it is retained for a financial expansion and growth of the concern. For example, if it is needed in the future, we want to be go anyway to that is through selling our additional shares, that and all. It is not always possible because of we have to be pay everything. In case of if the profit is higher, what we are expecting more than that we are received, it means we will be divide few amounts, that is we will be reserves in our organization name, that should be comes under the liability side. Because of that amount should, when we are going to dissolve the company, on that case, on that time we will be paying, that is we will be refunding to the shareholders. And the next one, it is a credit facilities. This is an important source of short-term financing. In this system, the goods and services are obtained on credit basis. So on this credit basis means in case of a cash discount as offer, and discount forgone becomes a cash of trade credit, like that and all credit facilities. So for example, if I'm going to buying a few products in some other company, they'll be giving an credit basis. You can pay the next month of the same amount. Then the next year, next month, I'll be going to purchasing a new product. The previous month, what I have received, that payment only I have made it. That is that previous month payment only we are paying. For example, in a salary, for example. So in a salary, what we have worked in the previous month, we are getting in the next month, like that. So like that, the material what we are purchased in the previous month, this month, the current month, I am going to pay. So this current month, I will be starting. That is, I will be getting again the raw materials or material, and I will be paid this material amount on the next month, like that. And then another one, it is for the short term loans. So these are the financial that is these are the commercial bank loans as creditors revolving credit agreements. They are giving a credit agreement, the accounts receivable and inventory or the principal assets used to secure short term business loans. Okay. So Maitri, Ramesh, you can clarify if you have any doubts, you can clarify now.
No, ma'am.
So after completing this unit, I will be share everything to Google Classroom as well as in the WhatsApp. Okay.
Yeah.
Right.
Yes, ma'am.
Yes. Yes. Thank you.
Thanks for your valuable time, ma'am. Thank you.
Thank you.